the last 5 years, one payment button quietly became bigger than most credit card companies. It has no interest rate warning, no credit check horror stories, no angry commercials about debt. It just says 4 words: buy now, pay later. And it's already inside the wallets of over half of Gen Z and millennials in America. But here's what almost nobody tells you. The fastest growing form of debt in modern history isn't hiding in a bank. It's hiding in your shopping cart. Buy now, pay later, or BNPL, sounds harmless. Split a $200 pair of shoes into 4 payments of $50. No interest, no fees. What's the catch? That's the exact question that made this industry explode from a niche checkout option into a $300 billion global market in less than a decade. But debt doesn't need a high interest rate to be dangerous. It just needs to be invisible. And that's exactly what BNPL is engineered to be. Debt so smooth, so frictionless, that your brain doesn't even register it as debt. To understand why this matters, look back at how debt has always worked. Credit cards, when they launched in the 1950s, came with something important: friction. You had to apply. You had to get approved. You saw a limit. You saw an interest rate. That friction acted like a speed bump for your brain, a small pause that said, wait, this is borrowing money. BNPL removed that speed bump entirely. One click at checkout, no application, no number staring back at you, just 4 small payments that feel less like debt and more like a coupon. Here's where the psychology gets dangerous. Behavioral economists call this payment decoupling, the idea that when you separate the pain of paying from the moment of buying, spending goes up. It's the same reason casinos use chips instead of cash. It's the same reason your brain feels less pain swiping a card than handing over paper bills. BNPL takes that principle and turbocharges it. Studies from the Federal Reserve found that people using BNPL services spend up to 20% more per transaction than those paying upfront. Multiply that across hundreds of millions of users, and you get a shift in national spending behavior that regulators are only now starting to measure. And this is where the trap reveals itself, because BNPL isn't really one loan. It's stackable. Nothing stops a person from opening 4, 5, even 10 BNPL plans at once across different apps for different purchases. There's no unified system tracking it, the way credit bureaus track credit cards. A 2024 study found that over 40% of BNPL users had multiple simultaneous plans running, and more than 1 in 4 had missed at least one payment. Miss a payment, and what looked like interest-free splits suddenly turns into late fees that, annualized, can resemble the interest rates of the same credit cards BNPL was supposed to replace. This is where history quietly repeats itself. In the early 2000s, subprime mortgages worked on a similar principle. Debt engineered to look smaller and safer than it actually was, distributed so widely and quickly that risk became invisible until it wasn't. BNPL isn't a housing crisis, but the mechanism: fragmented, frictionless debt growing faster than the systems built to track it, follows the same blueprint. Make borrowing feel effortless, spread it across millions of small transactions, and hope the cracks don't show until it's too big to easily unwind. Retailers love it because it increases basket size. Investors love it because growth looks incredible on a pitch deck. But the actual debt sits with the one group with the least visibility into how much they truly owe: the consumer. So where does this leave us? BNPL isn't inherently evil. Used carefully, it's just a payment tool. But the danger was never really about the product. It's about what happens when debt is designed to disappear from your awareness the moment you take it on. The next financial stress point in the economy may not come from a bank collapsing or a stock crashing. It may come from millions of everyday people quietly stacking small, invisible debts, one checkout button at a time, until the total becomes something nobody, including the borrower, ever fully saw coming.